Hello and welcome to the sentiment analysis for the week of June 28th. What a week last week was. We have a lot to talk about. So let's get straight to the biggest news of all. Last week I sold off two assets in my inventory that I've been holding for over a year. This was an incredible down drop. And that's really the only way I can put it. I got part of my analysis last week correct, part of it wrong. And that's where we're going to start really this week, talking about what I got right and what I got wrong. So let's get to the charts. Okay, we are looking at the monthly chart. And we actually ended up dropping lower on my support level. The support level was roughly around this area, and now it is significantly lower. But boy, this chart, amazing as it is, doesn't tell the story. The action this week is on the daily chart. This chart really tells the story. This chart brings it home. So let's get into it. Monday, Tuesday, and Wednesday. What a brutal drop in the euro. And if we look at the bottom of the candle and the top of the next candle, we can clearly see a cascade or stair-step impact. We see that the market clearly pushed lower. I didn't expect it to go as low as it did, to be honest. I figured 20 or 30 pips maybe, but 50 pips in that range was a bit of a surprise for me. Now we see the uptick on Thursday and Friday, but here is something to be aware of. On Friday, the upper wick is very strong, clearly showing more wick than body of the candle. That's important because it's suggestive that the market on Monday may push lower. And we actually have a few historical examples that do just that, where the market does indeed push lower. For example, this candle here suggests it, and we have this big beefy, brutal red candle behind it. The candle here and another big, beefy, brutal candle. Now, by itself, these indicators mean nothing. But when you couple them with the order book and the news, that is when you get to see a bigger picture. And the news last week was quite interesting and devastating for Europe. And we are going to get to that because that is the true tale. But what I want to focus on next, before we get to the news, is the order book. So as we look at the order book, we can see the buy and sell sides and a huge discrepancy of where the pressure is in the order book. This order book clearly shows prices poised to go lower. I don't know if we're going to set a new lower support, but we can definitely see that support level being tested again next week. And I think that is significant in relation to what we see on the chart. But the why, that really is the story. It's not often where we get news that actually really can be directly correlated to a market shift. But last week is a definite exception. We can directly attribute the downward pressure of the euro to the Strait of Hormuz being opened. This is one of the few cases where we can clearly see this particular situation. Because according to Euro News, according to the European Central Bank, Europe was betting on the strait staying closed. French and German governments were price gouging shipping fees. They were actually making money, deliberately keeping the conflict going. The blockade brought in a massive transfer of wealth into Europe. They were profiting while everybody was suffering. Yahoo Finance, TM, GM, Euronews, Forex.com. You can find all of this news all over the web of just how much Europe was hoping the conflict would continue. For example, the amount of money the European Union spent to deliberately keep the strait closed is estimated to be 35 billion US dollars, or roughly 30 billion euros. They ended up literally pumping money into the European economy, brokering war and conflict. As it stands recently, come September, the European Central Bank is likely to raise interest rates again. But they raised shipping insurance fees 500%. So for ships that traveled through the European region, they paid 500% more for their insurance. The most damaging for the strait reopening is a very real risk of deflation now hitting Europe. With the strait open, it directly impacts manufacturing for countries like France and Germany that now will have less manufacturing because there are going to be more global resources available at a cheaper rate. So while there isn't any definitive numbers how much they made, one can guess what 500% insurance hikes are likely going to be. It's going to be in the hundreds of billions of dollars, realistically. Now all that money is gone. They were hoping that the conflict would continue, and you would be paying more for your goods and services. Those days are gone, if this peace treaty lasts. That's the big question we need to deal with, whether or not it will last. But nonetheless, we have clear economic incentive that at a very minimum, France and Germany and the European Parliament were cashing in on the conflict directly. The news cycle is trying to spin this every way they can, but what it really is. They wanted Trump to fail. They wanted the conflict between Iran and Israel to continue. They wanted the strait to stay closed so they could make more money. Think about that long and hard. Now, I'm certainly not saying the U.S. is the good guy in all of this, but to deliberately build an entire economic framework around your own citizens suffering because of price gouging is really desperate. The euro is quite shaky, in all honesty. When you look at the market, and I'm not just talking about the last week, the last year, or even the last 4 years. I'm talking the entire 23-year history of the euro. You can see clearly that when compared to the United States dollar, the normalization of the chart, the normalization of the range, is really the best way to handle this asset. Despite its volatility, it is very consistent about its patterns. If we zoom out and really look at the market, we can clearly see a very long-standing history that goes back to at least 2014 of an asset that has a predictable range. For example, looking at the orange lines, or even if you want to look at a smaller range of the yellow lines. On the chart, you can see this range. And that's the whole point of why I trade the way I do. Because once you see this range, it becomes consistent enough to be reasonably profitable. Now, there are no guarantees in the market, and this isn't about getting guarantees. This is a rationality of a circumstance of being able to actually build a system to protect your interests. I'm entering a state with my own trading where I will be ending up selling off more and more of my trades that are over a year old. And with the negative swap carry that I have been earning on them, that's quite significant. When we look at the screen right here, we see the range that I have been predominantly working in over the last several months, compared to the longer term range that goes back to early 2025. So we have a clear pattern of expectation between buyers and sellers. And whenever you have a country, no matter what country, in this case Europe or the United States, making the kinds of decisions that we saw in last week's news cycle, you have a reaction, and that reaction isn't always going to be favorable. We see quite a few cases where U.S. reactions weren't favorable at all, and they actually hurt the market quite dramatically. For example, when we look at the entire COVID fiasco, you see from the standpoint of the market, the response against the euro was brutal. The European Union took a real significant hit. That's not to say the U.S. didn't either, but you're looking at a comparative relativity when you compare the euro against the U.S. for this kind of pair. When both pairs go down when both currencies go down simultaneously in value, what you see is a normalization. When both currencies go up in value simultaneously, you still have that normalization. What causes these massive, brutal trends in either direction is when there is no normalcy between the pairs. If euro goes up, it's because the U.S. went down harshly. And we can see that here on the chart. A harsh 4-month uptick against the United States dollar. The euro clearly had this advantage. Or let's go back to 2017, where you see a very brutal uptick against the US dollar. The euro crushed it. The US dollar suffered miserably. So we look at these charts going back to 2014. The euro got crushed and the US dollar did incredibly well. So we see these trends, these market changes, the dynamics, and then we correlate the order book with the buyers, the sellers, the institutions, the retail. All of that comes into play. And then we look at the news, and we can see, sometimes with very incredible clarity, what happened last week really become a focal point of an absolute market movement. So what I expect for next week, I expect the market to continue downward. There is enough interest, though, that I think the market is still going to stay within the range we are in, with some minor uptick like we saw on Thursday and Friday of last week. I don't think July is going to be a green candle, and I don't think June is going to end in the green. I think we're going to continue to see the stable range between both countries that we have right now and have had since early to mid 2025. But share your thoughts. What are you seeing? Did you see a bump in local prices when the Strait of Hormuz opened up? Did prices go up or did they go down? How did your economy respond to this very interesting news? Is it betting for peace or is it betting for continued conflict? Let me know. Please subscribe to the channel. Like, share, comment, and thank you for watching.